One big mistake federal employees are making, this is a topic we covered not too long ago. I want to revisit it because I think it's an important topic and I want to show my work here. Okay, so what we're talking about here is, you can call it one of three things: the TSP blind spot, you can call it not thinking about your financial plan holistically, only thinking about your federal benefits, or you can also think about missed opportunities in tax planning. All three of those things kind of relate together and it creates a big mistake that a lot of federal employees are making. That's what we're going to cover, and we're going to add a lot of context here, so stay with me throughout the course of the video today. But first, guys, of course, my name is Justin. I'm a financial planner. I've been doing this for a long time, helping federal families create custom financial plans, manage their investments, answer questions, help them make smarter decisions, just be an advocate for them, right? Also part of a federal family myself, so I know these benefits as they relate to my own financial situation. So if you have questions, you're working on something, we'd love to hear from you, be a resource for you. Please feel free to reach out. A lot of times we talk to federal employees and their situation looks like this. You got some savings in the bank, you got some home equity, we're good at staying in one place, paying down the mortgage, and then you've got a retirement account. That's typically the TSP, that's the focus, the default option. You got a balance there. It's probably pre-tax, okay? And that's okay, right? In fairness, the Roth option didn't exist until 2012. So when we come to the table with this big pre-tax balance, that was a good option, it's a good place to put money away. And there's been slow adoption of the Roth ever since then, okay? So that's what a situation really looks like. And the big mistake here, of course, is just having the TSP be the focal point of your financial plan, when there's so many other things that we need to be thinking about. And specifically with that TSP, there's a couple of issues, right? So there's accessibility issues and there's tax issues. And we're gonna talk about both of those. And as I mentioned, I'm gonna show my work here with some examples. All right, so just to back it up for 1 second, we're talking about tax diversification here. And that's simply diversifying the types of accounts you have set up within your financial plan to give yourself some more flexibility, more choices in the future. The virtue of tax diversification is we don't know which directions tax rates go from a legislative standpoint. We don't know. Of course, we're at historical lows, but we really don't know where it goes from there. We have a better opportunity of guessing or predicting what your income will be and where you're going to fall within the brackets, but we don't know what the rate might be in the future. So that's kind of why we incorporate these strategies, so that we can create some balance, some diversity that could benefit you in the future and give you choices. And so when we're talking about that, there's really three buckets we're talking about: pre-tax, or the traditional contributions. You make a contribution and it's deducted from your current year's income. We're talking about Roth contributions, or after-tax contributions. You make those contributions, you pay tax on them in the year you receive the income. It grows tax-free if you take it out in a qualified distribution. And then, of course, there's the taxable bucket, which is a pay-as-you-go account. That's something like a brokerage account, an investment account outside of a retirement plan, gives you access and flexibility, generally taxed at a little more favorable rate on long-term capital gains and dividends, lower than ordinary income anyway. So that's kind of the basis behind tax diversification and what we want to talk about here. Getting away from that pre-tax, 100% balance, creating some money in some of those other buckets, giving yourself some choices in the future, right? And so how do we do that, right? And what are the issues? First, we will talk about those issues. So accessibility, as I mentioned, is a big deal. At least in my mind it is. If you're a younger federal employee and you're kind of working towards building wealth, you want to have some access, right? There's a lot of life that happens between now and 55, now and 59 and a half. Some big goals you might want to plan for and be able to access money that's not necessarily, 1 or 2 years down the road. So an investment account could be a great opportunity for that, right? And of course, as I mentioned, it also contributes to that tax diversification part of the conversation, right? Where we're kind of taking advantage of those lower rates too. With the retirement account, you really can't access it until 55. If it's a TSP and you leave service at 55 or after, you'd be able to access 55. It's an IRA, you have to wait till 59 and a half. And with all Roth money, you have to wait till 59 and a half to access it, okay? So there's a little bit of a waiting period there. Of course, you get the tax benefits. That's the incentive from the government to save for your retirement. That's why we like to put money into these accounts, because there are benefits. So in my mind, accessibility is one thing, right? And so you do want to build a little bit of a bucket that can give you some flexibility, give you some choice in the future. That's the taxable bucket. Now, when it comes to taxes, okay, the second issue that we see with all having a 100% pre-tax TSP, there's really 2 or 3 big things that we see here from a tax perspective, right? The first one is gross versus net. All right, so when you take money out of the pre-tax balance, you have to pay tax on that as ordinary income. All the money that comes out of that account comes out as ordinary income, goes on your tax return, you pay tax on it, okay, whatever your tax rate is. So that can create a problem in one of 2 ways. Maybe you've underestimated how much you needed to save. You didn't think about paying a 22% tax rate or whatever bracket you fall into, and you didn't incorporate that. So that elevates the amount of assets you need saved in order to have a safe withdrawal rate. Okay, so that's one issue. Or potentially you're just not gonna have as much much income as you might anticipated, right? Because now you're paying tax on something that you hadn't thought about. The second issue is that can actually create a negative incentive to spend your money and do the things that you want to do, because you got this burden in the back of your mind of, I got to pay tax on this and I don't want to do it. Okay, so that's an issue, gross versus net. The second issue, RMD tax bomb. We know required minimum distributions hit this year at 73. Gradually, that age is going up to 75 in 2033. When you're required to take out a portion of your money from pre-tax retirement accounts, okay? And that generally starts at 3.65%. That's the starting percentage based on life expectancy numbers. And it goes up every year. So it becomes a much greater amount as time moves on. So if you have a big balance, you know, you got $1 million in your TSP, $1 million in an IRA, you got to take 3.65% out. That's $36,000 a year, right? So you got $2 million, it's double that. $3 million, you know, do the math, right? So that can create a problem there too. And then the third thing that we'll talk about is legacy, right? So if you're planning to leave a legacy for the kids or loved ones, whoever you want to leave money to, if all that money is in a pre-tax account when you pass away, the 10-year rule applies to your beneficiaries. And that simply means for a non-spouse beneficiary that inherits your money, they have to take the full balance out within 10 years. And this usually hits for folks when their kids are peak earning years, right? And it can create a pretty big tax burden, can make them jump into higher tax brackets and, you know, maybe lose a good portion of that money that would pass. And, you know, you want them to be able to take advantage of and enjoy and use to their benefit, right? That's the whole goal of legacy planning anyway. So those are kind of the three issues, right? And so that's why we want to create some diversification. All right, example number one. So let's say you planned your career that you needed $40,000. We're using rough numbers here. So you needed $40,000 to complement what you have going on from your FERS pension, from Social Security, whatever the guaranteed income source. So you need 40 grand from your retirement accounts, from your investments, okay? So that means that a 4% withdrawal rate, we love to reference the 4% rule. It's not really a rule, it's a strategy, it's a benchmark, but it gives us a framework of how much money we can take from a portfolio. So 4% of, you know, to get to 40,000 would give us $1 million portfolio. That's how much we would need. Okay, so we take that $40,000 out, but wait, we forgot we got to pay tax on that. You're in the 22% tax bracket. All of a sudden, your $40,000 becomes $31,000 and change. Okay, because you paid 22% tax on that. So what you would need to actually withdraw would be, you know, a much higher number. And you can find that number by taking the amount that you need, divide that by 1 minus your tax rate. Okay, so in this case, $40,000 divided by 78%. That'd give us $51,000 in change. That's what you would need to take out. So now if you get that same $1 million portfolio, it's no longer a 4% distribution, it's a 5.1% distribution, okay? So it changes the math quite a bit. And if you're looking at how much you would actually need to save to get 50 grand out on a consistent basis, using the 4% rule, it's no longer $1 million, now it's 1.25 million, okay? So that's how the numbers change, gross versus net. So that's one of the issues that we see. Second issue, and I'm gonna share an example with you here. This is some lovely clients we're working with, some new clients. They're in their mid 40s, doing awesome, like great family, great careers, and bright futures ahead of them. They've got about $750,000 saved right now, and they're making great contributions to their TSPs, both federal employees. All their money's in pre-tax, right? So it's tied up in TSP pre-tax accounts. They're currently saving about 10% of their income towards, you know, the future goals, right? So 10% of their income is flowing into the TSP. If we project that at an 8% rate of return in 15 years, it gets them right around age 60. If they don't make any future contributions, that 750 grows to around 2.36 million. If they do what they're currently doing, saving around 32 grand a year combined, that amount grows to 3.3 million. So being able to contribute about $20,000 more a year was a 6% increase, you know, so $52,000 flowing into that 750 starting balance at 8% for 15 years. Now you're talking about 3.9 million. Okay, so in 15 years, fast forward, if you got all that money still flowing into the pre-tax bucket, 3.9 million is a lot of money in a pre-tax bucket. Okay, now you're not at RMD age yet, but you can imagine how that's going to grow in 15 more years. We run the math, we talked about a 3.6% distribution starting at age 75. So that's a big chunk of change, okay? And that has real potential to push you into a higher tax bracket. That's what we're talking about here. So a couple options for you guys to think about and for them to think about too. This is kind of what we talked through, changing your contribution mix. That's the first option, right? So how much should you be contributing traditional versus Roth? Now they're in the 24% tax bracket. So one other consideration here is any dollar that they put into Roth, now they have to pay tax on. So if they max out next year, 47 grand going into both of the Roths, into the TSP, it's gonna add $47,000 to their taxable income. It's gonna add about $11,000 in change to their tax bill. So, you know, almost $1,000 a month flowing into taxes that before they didn't have to account for. Will that impact their ability to save that extra 20 grand a year that we talked about? It probably does. So that's something we need to work on. And that's where we kind of get hung up Roth versus traditional. Nobody actually thinks about the impact to your current cash flow, okay? So big consideration there. Now, how do the numbers change? Let's say they go 50-50, okay? So they start contributing 50% to the traditional pre-tax bucket, 50% to Roth, and then a little bit of money flows into taxable, right? So there's some money left over that they wouldn't be able to contribute based on limits. So that changes the equation like this. Instead of having 3.9 million in pre-tax money, now they've got 3 million. They've got about $700,000 in a Roth bucket. They've got 200,000 in a taxable bucket. Okay, so that's kind of how the numbers change there. And if they went even further and they said, look, we really want to focus on building that Roth bucket, we're going to go 100%. We're going to go all in on the Roth. We're going to pay the $11,000 a year. And we're going to make it work. We're going to cut money. We're going to cut expenses somewhere else. Now that flips the script even more. So now you've got about 34% of your money in the Roth bucket after that 15-year period. So we're still talking about that 15-year period making 8% a year on your contributions, just now they're flowing to Roth instead of traditional. So you'd have 1.35 million in the Roth bucket, 2.3, something like that in the traditional bucket, and then again around $200,000 in their taxable bucket based on their footprint. So you can see how that might translate to your situation, okay? And just for fun to look at that, it's 15 years out, of course, it's not RMD age, but 3.9 million times your 3.65 starting RMD percentage, that gives you $142,000 coming out as a required minimum distribution. So again, that could really move tax rate. It's going to continue to grow and be exaggerated even more so. All right, and then lastly, the last part of that is the legacy planning, which if you're passing on $4 million in a TSP account, $4 million in an IRA account to a non-spouse beneficiary, you got 10 years to take that out. With no growth, you're taking 400 grand out a year. What's that going to do to your tax rate? Or you take it all out, in a big chunk, you're just losing more. So you don't have the opportunity to kind of, work with the tax rates and make a better strategy there. All right, so that's kind of the big mistake revisited, just talking tax diversification, talking how to think a little more holistically about this portion of your financial plan anyway, and kind of get away from that TSP blind spot and the tunnel vision just on that retirement plan and the pre-tax contributions. It really does depend on what your tax rates look like, what your situation and goals are. There's no right or wrong mix on this stuff. It just depends on, your situation and the priorities that you want to make. So keep that in mind, right? All right, so if you found some value here, I know it's a lot of information, but would love if you would give us a like and a subscribe. And if you could share with a friend, would appreciate it. Until next time.